Have you ever wondered how a mere piece of paper or a digital number on a screen holds such immense power over our lives? Well, that's the intriguing concept of money for you. Money, in its simplest form, is a tool that facilitates the exchange of goods, services, and resources. It's a key player in our society, shaping our lives, our choices, and the world around us. Let's break it down. At its core, money is a medium of exchange. You can trade it for a shiny new gadget, a delicious meal, or a comfortable home. It's a universally accepted token that eliminates the need for a direct barter system, where you'd have to find someone who wants what you have and has what you want. Money simplifies this process, making trade more efficient and convenient. But money is not just a medium of exchange. It's also a store of value. We can save it today and use it tomorrow, next month, or even years from now. It allows us to plan for the future, save for a rainy day, or invest in opportunities. The value stored in money might fluctuate with inflation or deflation, but it doesn't perish like perishable goods. It's this durability that makes money a reliable store of value. But money hasn't always been the coins, notes, or digital numbers we know today. It has evolved dramatically over centuries, from the barter system of ancient times, where goods were directly exchanged for other goods. We moved to commodity money like shells, beads, and precious metals. Then came representative money like banknotes, which were backed by gold or silver, and today we're in the era of fiat money, which is not backed by a physical commodity, but by the trust and confidence we place in the economy. Now, we're seeing the rise of digital currencies and cryptocurrencies, taking the evolution of money a step further. The essence of money remains the same, but its form continues to change, adapting to our ever-evolving society and technology. That's how money, in its various forms, has become an essential part of our daily lives. But how is money really created? What's the process behind it? Well, let's dive deep into the physiology of money. The creation of money primarily takes place in two stages. The first involves the country's central bank, and the second involves commercial banks, and the system known as fractional reserve banking. To kick things off, the central bank, say the Federal Reserve in the United States, or the Reserve Bank of India in India, plays a critical role in controlling the money supply. They do this by buying government bonds or short-term government debt. When the central bank purchases these bonds, new money is essentially created. This money then goes to the banks from which the bonds were purchased. But the story doesn't end here. This is where commercial banks and the fractional reserve banking system step in. Now, you may be asking, what on earth is fractional reserve banking? Well, it's quite simple. This system allows commercial banks to lend out more money than they actually have in their reserves. Let's imagine a scenario. Say you deposit $100 into your bank account. The bank is required to keep a fraction of that deposit, say 10%, in reserve. This means the bank can lend out the remaining $90 to other customers. When those customers spend that $90 and the recipients deposit that money back into the bank, the process starts all over again. This cycle of depositing and lending can exponentially increase the money supply in the economy. However, central banks can influence this process by changing the reserve requirements or altering the interest rate, thus controlling the overall money supply. When the central bank wants to increase money supply, it lowers the reserve requirements or decreases the interest rate. Conversely, when it wants to decrease the money supply, it raises the reserve requirements or increases the interest rate. So the physiology of money is not as simple as it appears, right? It's a complex system of checks and balances where every action has a ripple effect throughout the economy. It's a fascinating process, isn't it? Now that we know how money is created, how does it circulate in the economy? Well, to understand the circulation of money, think of it as a river, flowing and ebbing through the landscape of an economy. The main facilitators of this flow are the financial institutions, banks, credit unions, and the like. They act as bridges, allowing money to move seamlessly from those who save to those who borrow. Let's break it down. Imagine you've just earned your paycheck. You deposit it in a bank. Now, this doesn't mean your money just sits there collecting dust. Quite the opposite. Your money is now active within the bank's reserves. On the other side of the coin, there are people or businesses who need funds for various reasons. Maybe it's a family looking to buy a new home or a startup seeking to expand its operations. These borrowers approach the bank for a loan. Here's where the magic happens. Your deposited money is now loaned out to these borrowers. This is the essence of money circulation. Your savings become someone else's means to fulfill their financial needs. But what about the interest, you might ask? Well, that's the incentive for you to deposit your money in the bank. The bank pays you interest on your savings while charging a higher interest rate to borrowers. The difference between these two rates is how banks make a profit. So, you see, the circulation of money isn't a one-way street. It's a symbiotic relationship between savers and borrowers, facilitated by financial institutions. This cycle continues as borrowers repay their loans and savers continue to deposit their earnings. One more thing to note. This cycle isn't isolated. It's interconnected with various other economic activities. For instance, when businesses borrow and expand, they may hire more employees who then earn and save, thus further fueling the circulation of money. And there you have it, the fascinating journey of a dollar, pound, or rupee as it moves through the economy. So, the flow of money keeps the economy running like the blood in our bodies. But what gives money its value? Why do we trust it? These are questions that often baffle our minds. You see, the value of money is a fascinating concept. It's not intrinsic, meaning it's not derived from the material it's made of, like gold or silver. In fact, most modern currencies, including the dollar, the euro, the yen, are what we call fiat money. Fiat is Latin for let it be done, and fiat money is money because the government says it is. It's not backed by a physical commodity, but by the trust and faith of the people who use it. It's like a social contract. We, as a society, agree to assign value to these pieces of paper or digital numbers in our bank accounts. We trust that others will accept it as a form of payment. And that trust is what gives money its value. But this trust is fragile, and if it's broken, the value of money can decrease or even disappear. This is where inflation comes into play. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. When there's too much money chasing too few goods, prices rise. If your income doesn't keep up with inflation, the purchasing power of your money diminishes. You can buy less with the same amount of money. For example, if the inflation rate is 2% per year, a movie ticket that costs $10 today will cost about $10.20 next year. It's the same movie ticket, but your money is worth less. In essence, inflation erodes the value of money. It's a hidden tax that we all pay, whether we realize it or not. So, in this intricate dance of trust and faith, supply and demand, the value of money is constantly changing, constantly being negotiated. It's a powerful symbol of how our society operates, how we trade, save, invest, and plan for the future. It's faith that gives money its value and inflation that erodes it. So, what's next for money? Are we moving towards a cashless society? It's a question that's been buzzing around for a while now. The rise of digital currencies is reshaping our understanding of money, and it's worth taking a closer look. Digital currencies, such as Bitcoin, Ethereum, and a host of others, are becoming increasingly popular. They operate independently of a central bank, democratizing the control over money. This decentralization is a game changer. It has the potential to disrupt the way we transact, invest, and even how we perceive the concept of value. But digital currencies are not just about buying a cup of coffee without physical cash or card. They hold the promise of creating a more inclusive financial system. For the billions of unbanked individuals worldwide, digital currencies could provide access to financial services, enabling them to participate in the global economy. Yet, as with any revolution, the journey of digital currencies is not without its hurdles. They are highly volatile. Their value can skyrocket or plummet overnight. This poses a significant risk to those who choose to invest in them. Additionally, their anonymity and lack of regulation make them a haven for illicit activities. Then there's the question of energy consumption. The process of creating or mining digital currencies requires a considerable amount of energy, raising environmental concerns. But perhaps the biggest challenge facing digital currencies is acceptance. For them to truly reshape our monetary system, they need to be widely accepted by businesses, governments, and individuals. And that acceptance hinges on trust, something that takes time to build. Despite these challenges, the potential of digital currencies is enormous. They represent a new frontier in the evolution of money. They offer a glimpse into a future where money is not just a physical entity, but a digital asset, easily accessible and transferable across borders. The future of money could indeed be digital, but it's a journey filled with challenges and opportunities. As we move further into the 21st century, it's a journey we are all embarking on, whether we realize it or not.